Hey everyone, thank you for joining us for another episode of The Agent Investor. The Agent Investor series is a series geared towards helping investors who are operating in the commercial and multifamily space make more informed decisions through conversations and professionals working in the commercial and multifamily space. So in today's episode, we have a good friend of mine, Matt Reith, local loan originator for residential and commercial. And thank you so much for joining us, Matt.
Thanks, Brandon. Appreciate you having me. I know we talked about this for a while and happy we're finally connecting on this.
Yeah, no, absolutely. So we're going to jump right into it. Matt, tell us a little bit about yourself, what's going on, who you are, where you're from, all that good stuff, what you do.
Yeah, sure. Local here in Connecticut, like you mentioned, have an office in Shelton, a loan originator, as you alluded to. I handle residential and commercial loans for investors or those seeking to buy investment properties. I also help owner occupied for people who are looking to buy their first or second home as well. But for the purposes of this talk, we're gearing more towards investors. So that's kind of what I do. I help people get a loan so they can purchase an investment property.
All right, pretty straightforward. All right,
Yeah.
easy. All right, so let's dive a little bit into some more specifics. So tell us a little bit about some of the loan programs that you have available to investors, or just in general, some of the programs you have available.
Yeah, there's a lot of programs out there. I'll just break a couple down. Specifically to Connecticut, there's owner occupied loans out there. Those are loans for people who are going to buy the property, let's say a 2 to 4 family, and live in the property. Those are separate than investment loans. Some of the loans that you can go as an owner occupant or would be like government loans like FHA, CHAFA, but those are different requirements than investor loans. And the reason why I make that distinction is because the requirements that you need to meet, the hurdle that is that you need to overcome as an investor are much different than if you're going to live in the property. So the metrics and the qualifications for the loan are going to be different. And one of the most popular products that we're seeing on the street right now is a loan program called the debt service coverage loan.
Yeah.
And really what that means, it's a $25 phrase for basically does the rent cover the mortgage? That's it. If let's say the mortgage is $1,000 and the rent's $1,000, you got a debt service coverage ratio or debt coverage ratio of 1. If the mortgage is $1,000 and the rent's $1,250, then you got a debt coverage ratio of 1.25.
Got it. And it's also abbreviated as DSCR.
It is, yeah. So some of the more general people out there or other investors have noticed a DSCR loan. The advantage is that it's great for investors because it truly can build out a portfolio rather quickly because as a lender, we're really just looking at it from the perspective of that property and we're underwriting it for that property and very little requirements for you as the borrower and some general requirements for you from a borrower perspective. And this kind of changes shop to shop. But in general, what we see are we want to see a 600 credit score or higher.
Yep.
We want to see that you own your own property, your own house or condo, whatever, that you at least owned it for 12 months or more. Of course, on-time payments are a big thing. And then down payment requirements, those can be sourced from a number of different pools, right? You can pull money, you can come out of retirement funds, you can have a couple different ways to get the down payment option. Generally speaking, today is the 29th of February of 24. Those guidelines, generally speaking, for a single unit house or condo would be about a 15% down payment. And then if you're going to go to 2 to 4, you're looking at a 25% down payment. So 75% loan to value.
Got it.
Yep.
And again, this DSCR is specific to investment property, not owner-occupied property.
This is investment property only. Now, the difference would be as an owner-occupied, let's say if you're looking at an FHA property and it's a 3-family, as an example, that down payment might only be 3.5% to 5%.
Got it.
So you're talking a big difference, but you're going to live in that property. So that's why I kind of gave you some overarching guidelines that you can use from an investor standpoint, just kind of wave tops. Obviously, every situation might be different. If you're going to do a short-term rental, those guidelines might change versus if you're just going to rent it. If it's not rented out, there's other stipulations where the property is located. So it's really important to chat with someone like me to kind of drill down a little bit on it just to make sure you're getting the actual cost of it, what's going to be your responsibility at the closing table.
Got it. Got it. So just to refresh, all right, everyone really knows about FHA and maybe conventional. Is FHA considered conventional and to a degree?
No, conventional, you can also have property out there. There's other programs. So FHA is strictly like a government loan.
Got it.
Conventional is something else. That's a separate loan. So you have your DSCR and then you have your conventional. Those are two separate loan programs. You can also use conventional financing to build out a portfolio as well. The requirements are going to be a little bit more than just a debt service loan. You're going to come together with a little bit more documentation. The loan to value might change a little bit, but generally the same process.
Sure. And as you mentioned, you can purchase owner occupied and you can purchase investment property with conventional loans. And it seems like
Correct.
conventional loans, based on my understanding, are
Hmm.
probably a nice middle ground because even though it's a little bit more work up front than maybe a DSCR loan, you're probably getting better terms in the long run with a conventional loan.
You are, yeah. So the debt service loan is more, it's easier to do from an investor standpoint, less paperwork involved. You just look at the house, make sure it works. On the conventional side, because you're supplying more documents, it's a full doc program, meaning we're looking at everything. The advantage of that to you as an investor is that it's going to be a little bit cheaper on the fees and the rate's going to be a little bit sharper too.
Got it. Got it. And I'm assuming when someone approaches you, you probably would give them options based on their situation or circumstances.
100%. It's ultimately, what are you trying to do? I have a couple different investors and they're like, nope, I just want to do debt service loans. I'm fine with that. And others are kind of like looking for a blend. So it's really taking that tailored approach to each client.
Got it. Is that 10? I don't know if that's still out there, that 10 property max on your conventional loans. Is that still a thing? I haven't.
Yeah, I think it's off the cuff. I couldn't tell you. It's like a 10 property max. Nobody ever is going to hit it really because you got to also have it. Everything has to work on it. So
Yeah,
I
yeah.
think it's a 10 property max or $5 million. I would have to look that up, but
Sure. Yeah.
I appreciate you putting me on the spot on that.
Yeah. Don't even worry. That was something I heard years ago when I first got into it, and I just haven't circled back on that. I mean, I'm not.
I don't think I've ever seen an investor really hit it because they just go, okay, we're going to actually flip over and be an actual investor, use these loan programs, how they're tending to be used.
Oh, cool, cool. All right, so we'll jump into the next one. So you work with different levels of investors. Some are newer, some intermediate, and some much more sophisticated, some institutional. So when it comes to more sophisticated or institutional investors, there's usually a capital stack involved. It's not just a typical purchase like, hey, here's my 25% down or 5% down on owner-occupant property. It's a bit more complex than that. Let's take a deeper dive into that. Let's talk about the capital stack.
Yeah, so the capital stack in very simplistic terms would be just how we're structuring both the debt and equity. So the debt is just any loans that you have, and equity is just the money that you're bringing to the table to fulfill in anything the debt doesn't cover.
And
And
really quick, I'm going to pause just to kind of give people a frame of what type of properties are being acquired with this kind of debt. So,
yeah, I'll give you an example. So
yeah,
let's say you're trying to acquire a $10 million multifamily property
there you
in New England, right?
go.
And you're their agent, and you say, "Hey, I got this multifamily. It's I don't know, 50 doors, 80 doors, whatever it is, and it's
Yeah.
for 10 million bucks." And what the capital stack would entail, generally speaking, would be like a 70% loan to value for the senior debt, your first mortgage.
Got it.
Okay. So then you're missing another 30% to get to that $10 million. So you get a $7 million loan, and then now you got to come up with another $3 million. And there's a variety of ways that you can do this. Very simple structure would be $7 million of debt and then $3 million of equity. Now, people are like, well, I don't have $3 million laying around, and not many people do, right? So, what you would do is you would go, and a big thing over the past couple of years we called syndication.
Yeah.
So, you pass around the hat to friends, family, and investors, accredited investors, and funds and whatnot. And let's say you put in 5% of your money, which would be $500,000, and then they cover the other portion of the loan at the other 25% at $2.5 million. So that would get you your $3 million of equity and a $7 million loan. That would get you your $10 million.
Got it.
So that's one way to do it. Another way to do it, as using the same example of $10 million, is to use what would be called a mezzanine loan. That would be let's say, again, 70% loan to value on the debt side. And let's say you're going to get another loan, a second loan on top of that loan
Yep.
for, let's say, I don't know what the market is on that off the cuff, but let's say it's going to go up to, you're going to get another $1,000,000. So then you only have to cover the 20%. And again, there's some other structure there where you got the senior loan at 7 million, a
Yep.
mezzanine loan for $1 million, and then you got to cover the other 2 million. So let's say you only have to raise 1.5 million yourself, and then you throw in another $500,000.
Sure.
And it doesn't have to be a $500,000. Generally speaking, what we see is anywhere from the sponsor, the developer, or general partner. All three terms are interchangeable, right?
Okay.
The owner, basically you, the operator doing the work, are going to contribute anywhere from 1% to 10% of that capital stack.
Got it. Absolutely. Okay, cool. So you talked about the two structures. Syndication seems, I mean, I'm involved in a couple myself. It seems pretty straightforward. Just to kind of reiterate. So basically you have your senior debt, or is it the same as first position? It's kind of just
first position loan. Yep, senior debt, first position.
Your first position or senior debt, which is really the bank. And then you have the debt behind that, which is your capital that you've raised through syndication, through investment partners, through friends, family, like you mentioned. And then that covers the whole capital stack for that, for syndication in that aspect.
Well, the only difference I would say is that there's different tiers on the syndication side or the equity side. Sure. There's something called a waterfall model. And that's basically you're taking the equity, and a very common structure of the waterfall will be like a 90-10 model where, let's say, Brandon, you're buying a property and you got a rich uncle and he's going to give you 90% of the equity and you're going to contribute 10% of the equity. And there's going to be some kind of return hurdles that you have to meet all the way through. And generally it's about 8 to 10% return of their capital, and they get their money back. So that's how that kind of breaks down on the equity side.
Got it. And then I know there's other models such as like preferred equity things.
Yep. Yeah. So preferred equity or pref equity, they're looking for like a straight return, let's say 20% return. I'm working with a developer now. They're basically all they're offering is 20% return. So you bring them, let's say they're going to bring $5 to $10 million into your deal. They want 20%, and any upside beyond that you keep. That's all they're looking for.
Got it. Understood.
And there's there's like 15 to 20 different ways you can structure this.
Yeah.
And there's a lot of great courses on waterfall modeling, but it's a little bit more in depth than a quick chat we're having right now.
Got it. Absolutely. And individuals who are going after these larger properties and they're speaking with the bank, what is the bank looking for in these borrowers? Because they're part of the team acquiring this property, because I'm assuming to be more than one individual. What is the bank looking for in that team to qualify them?
Yeah, that's a great question. So generally speaking, you're looking at what's their net worth requirement, who's signing as a guarantor on the loan, what kind of balance sheet are they bringing to the table, what's their experience level, a simple Google search to see if you have any fraud against you or criminal activity, things like that. And I would encourage you, if you're looking, for the listeners out here, if you're looking to invest as a limited partner, an LP, do your same due diligence on the sponsor that you're investing into. There's plenty of people on LinkedIn who post about this or offer free advice of what to kind of look for in a sponsor, because you see some crazy stuff on some deals.
Yeah, absolutely. And another question for you, the mezzanine debt. Can you quickly touch on that again? So can you explain that in a little bit more detail, just so people have an understanding? Because I think the syndicate model of...
In very simple terms, it's a second loan that you're going to get that is going to be a higher interest rate.
Got it.
And it's higher in the capital stack. So let's say if the senior loan is at 70%, it requires you to bring less money to the table, depending on how high up in the capital stack they'll go. So let's say they go from 70 to 90, then you're only bringing 10%. And however you're structuring that is how you structure that.
And with that mezzanine, is that usually being supplied by the same bank or institution or source? Or is it
generally speaking, no. They're depending on what level of deal size it can be.
Okay.
It goes into something called like a stretch senior loan. But generally, it could be an outside vendor bringing that loan into play. And the rate is going to be much higher. The fees are going to be higher just because it's more high octane debt.
Got it. Understood. It's not first position. It's
Not first position. Yeah. Yep.
Understood. All right, now,
Yep.
perfect. Hope that was good for everyone. So, next question for you regarding acquisition methods in terms of funding. What are some of the uncommon but effective ways you've seen investors fund deals that may not be typical to your normal transactions?
Yeah, that's a good question. It really depends on the size of the deal.
Sure.
If you're in the 3 to 4 family, if you have 3 to 4 people that are willing to invest or have different skill sets, I'm working with an investor right now. One's the carpenter, one is kind of the money, and then one's kind of the marketing and acquisitions. So those 3 people work really well together. So building out a good team. And I have seen it where other investors are coming in and they're doing it basically all themselves. I think it gets challenging as you're trying to scale more. I mean, just from an agent perspective, just how hard is it to screen? You put up a rental. If you've ever done a rental as an agent, it's such a pain. Your phone's getting tapped nonstop for like one property. Now do that over 12, 15, 50, it's really tough. So just building a good team out, that's one method I saw that's very effective.
So just to touch on that one, in the smallest, so say they're in the 2 to 4 unit space and they're doing something like that. In terms of the loan, are you looking for certain qualifications for certain individuals in there, or is it based on the ownership in the partnership?
Yeah, so the partnership wouldn't really be looked at because it depends on where they are in their business cycle. But generally, one person out of that, let's say 3 people, would be on that loan as a guarantor, and then the other person would provide the money. But we have outlets where they don't care where the money's coming from as its source because, again, we're underwriting the property and not so much the business itself.
Got it. So another topic, seizing of funds. Really on a smaller, I don't know how, honestly, I personally don't know how it works in the larger scale. Maybe that's something just to throw out there as well. But I know in a smaller scale, some say you need 3 months. And I know I've heard others say, as long as it's there day before closing, we're good. We don't care.
Yeah. So, it really depends on each lender's requirements.
Got it.
I have outlets where they don't care. They don't ask you where the funds are coming from. They don't want to know. As long as it's there for closing, they're okay. Where there are other outlets, they're like, hey, we want to see this in your bank. And just so everyone knows, seasoning means it's in your bank account for X amount of time, right? So it's seasoned in there. So I'll give you an example on if you're buying a property to live in, you can't just show up to the closing table with $50,000 cash. We got to know where it's coming from. We have to show it into your bank account. It has to be seasoned for, at least a month or 2, depending on programs. You can't just show up with a bag full of money and say, here you go.
Yeah.
It raises some eyebrows. So I would say check with whoever you're working with as your loan officer and understand the seasoning requirements. Generally speaking, 3 to 6 months would be fair, but there are other lenders out there that I work with that we write loans with that they don't care about seasoning requirements.
Got it. I know it's an odd question, but what about
it's a great question, actually, because it could kill a deal.
Yeah, what about in the larger acquisitions? I've never been involved as a GP, but LP I have. But when it comes to large, is there any such thing as a seasoning period when it comes to larger acquisitions, or it's a different monster?
It's a different monster. So there's a lot to unpack there. It really depends on where you're going to. Bank, debt funds, CMBS. So it kind of changes as you go through. But generally speaking, what is going to be supplied is your personal net worth statements.
Okay.
And they're going to have different requirements as to loan requirements, as far as you want to see 60% or 20% of hard costs that you want to be covered, or 100% of the loan amount and net worth coverage. So it really changes by what type of program you're doing, what you're looking to do. And you're looking if you're doing development versus acquisition. So it changes a little bit. It's more convoluted the higher up you go.
Got it. So also what I'm gathering from this is that it's best for those considering getting into a project, whether small or large, engage with someone like you from the start, and don't assume and get into it and go off this video and then say, hey, you said this in the video, and then
Well, hey, Brandon, I look at a lot of 1040s and taxes every day, right? but I'm not a CPA. I still hire my CPA because they're the experts on it. They're looking at tax laws a lot more than I am.
Yeah.
So I keep trusted professionals in my corner.
Yeah, no, absolutely. So I definitely recommend for the viewers to do your due diligence before you even start with a project. Reach out to someone like Matt, and then just have the conversation about what your intentions are, and then let him kind of give you some guidance on considerations as you get into your projects. So we'll jump into the next question here. Based on what you're seeing in today's market, where do you see the economy and real estate going in the next, say, 3, 6, 12 months over the course of the next year?
Okay, 3 to 6 months. Today, the PCE came out pretty much on point. So, as far as where do I think things are going, I think I'm on the side of the coin where I'm always an optimistic person, I guess, with some pessimism sprinkled in. I think the markets are pretty much going to stay where they're at for another 3 to 6 months.
Yeah.
I'm talking the overall probably economy until we get some more data coming out where I think some of the inflation pressures are going to start to ease. How that translates into real estate is I think that the rates that we're seeing are going to come down. Now, when that is, my general belief is probably within 6 months. We're in Q1 right now as we record this. So I'd probably say tail end of Q2, moving into the back half of 24, and certainly beginning of 25. Do I think there's still good deals out there to be had? Yes. Yep. Do I think that people are still buying houses and investment properties? Yes, all the time. Don't discount the reason why people need to sell. You don't know that backstory, and people might do it at a discount. They might need to get out of there and offload the property. So there's always deals out there in any market. You just got to do your due diligence and find it. As it relates more specifically to multifamily and more investor grade product, definitely always deals out there. But I think the 10-year, which is my personal belief, is going to come down. So you'll have some cap rate. Obviously, it's a risk-free rate, so the cap rates will correspondingly come in line with that, and interest rates will also come down. In terms of rental growth, I would be very cautious when looking at a pro forma, and we're seeing this nationally too, that the rental growth is really market to market. Really identify, be the expert in your market, and I would be very cautious if you're seeing a broker packet or a seller offering, let's say, 5% year-over-year growth on rents. And then, of course, like no growth on expenses, right? Because that always happens.
Yeah.
So I would really dig into those numbers, but I am definitely optimistic on where we are moving forward from here in terms as on both sides of the coin, both as a owner occupant, like buying a home, and then also on the investor side of the house. I'm optimistic.
Got it. Yeah, no, kind of going off of what you said, I've been reading recent reports, and it looks like us in the Northeast, we're still in a pretty decent place when it comes to rent growth. Not so much like booming rent growth, but just that 2% over the next, kind of stable, where some of the southern markets have been saturated.
Yeah. I think if you look at some of the Sun Belt markets, they're kind of tapped out. There's a lot of new product coming onto market. So, until that gets absorbed, I think it's going to be tough to forecast perpetual growth at 2 to 4% year over year.
Yeah. And I mean, kind of going off script, in Connecticut, it seems like the biggest issue, I mean, they keep saying it is inventory, but it seems like it's inventory.
Mm-hmm.
There's not a lot. I mean, there's some development going on. It looks like it's a lot, but I honestly don't think it's a lot compared to if you go in. I was in Salt Lake City at one point. I mean, I was like, holy crap. Like, everywhere you look, there was a new complex going up. Whereas Connecticut, you may see one every once in a while, but I think it's still slow growth here, which keeps the rents at stable levels in my personal
Yeah, I would agree. Yep.
So, all right, cool. So we're actually going to be breaking away from the real estate and the loan-based questions and kind of getting to more personal as we start to wrap up here. So when you're not doing your loan origination, not helping out investors, what do you do in your personal time?
Well, I got 2 small girls. They're young and they're 5 and 7, so they like to do a lot of outdoor activities. So most of the time I'm chasing around them on the weekends. I'm a lifelong learner, so I'm always pursuing some kind of form of education. So generally I dedicate 1 or 2 weeknights and a small portion of my weekend to whatever certificate or educational requirement I'm working on. And then just trying to spend some time with my wife and the family. And then also, as I get older, it gets harder and harder, but just trying to stay in shape and stay active. So,
yes, I know what you mean.
Yeah.
It's all good. So how can people find you, get a hold of you? What's the best way?
Yeah, my cell phone, it's basically on me all the time. I'll share it with you guys or LinkedIn. I try to post a lot of pertinent. I speak a lot about business, economics, and real estate. So if you want to follow me, love to interact, and please feel free to DM me too. If you have scenarios, you can run it by me, and certainly I can weigh in and hopefully get some.
Yeah, absolutely. And I'll make sure to take care of putting all your contact info in
Thank
the
you.
post when we're completed with this. And another question: do you have any final? I guess last question: do you have any final words for the audience or anything you want to leave anyone with?
From an investor standpoint, do your due diligence. Make sure you understand things. There's a lot of free resources out there. Pick up a couple books on real estate investing, especially if you're newer to real estate in general. It's your first year or two. There's a lot of different networking groups too. I know you run a network group. Go to the groups. You can meet a lot of great people there. You can network. If you're newer to investing and multifamily in general or real estate in general, it's about relationships in this business. So go meet people, go out and talk to people. You never know who you're going to need either.
Absolutely.
So go network.
Yeah, absolutely. To keep it simple.
Yeah, keep it simple. Go network.
All right, cool. All right, Matt. Well, thank you so much for joining us on this episode of The Agent Investor. And to our viewers, thank you so much for your continued support and viewing this episode of The Agent Investor. Until next time, I wish you all the best in your health and your happiness. Thank you so much, Matt, for joining us. Thank you all for joining us. We'll catch you next time.
Take care.